Good morning. Welcome to Trading Hour. I am Reema Tendulkar. With me is Pavitra Parekh, and things have picked up. It was a quiet start, flat. The Nifty opened at that 16,550 mark, but since then, it's added on close to more than 100 points, in fact, on the Nifty, while the Sensex too, as we speak, is higher by close to about 0.7%. And this comes in the context of weak Asian markets, where markets in South Korea, markets in Taiwan, markets in Hong Kong are down close to about 1%. The stocks of the day are clearly the cement twins. Ambuja Cement is now up close to about 10-odd%, while ACC is higher by close to about 2.5% after the promoter group has decided to infuse a massive 20,000 crore rupees into Ambuja Cement. Apart from that, the Nifty PSU Banking Index is also higher in trade, and it's led by State Bank of India, post the CLSA target price increase to 680. But even the others, like Union Bank, PNB, are all contributing on the way up. A couple of the other big movers, especially on the way up, include Adani Ports, M&M, as well as Bajaj Finance. Hi.
Hi, good morning. So, I was looking at the last week move. Of course, our markets were lower, around 1.7% in the red, but this is compared to the kinds of fall that we saw on the Dow and the S&P of around 5 to 6%. And it is really the banking pack which stood out. And on the downside, it was, of course, the IT. Once again, today, the banks are doing quite well. So a few of those will come up for you. Those stocks are holding up quite well. The Nifty IT pack was down around 7% last week. This week, Reema, key Q will be the Accenture's earnings and, of course, the guidance. Thursday, I'm sure you're watching out for that one closely. So we'll watch out for the guidance for that as well. So the entire IT space could be in focus. Keep those on your radar. Some of the financials holding up well. On the downside, it is a few of the pharma stocks. So that's what's happening with the market action. We'll keep coming back to this. But first up, let's quickly run you through everything that we have lined up on the show for you today. The indices gain after a muted start. Financials and IT charge ahead. Pharma slips. The mid-cap slag. We'll discuss the way forward for the market with Rohit Srivastava, founder of IndiaCharts.com.
The big anticipated event to look forward is India's inclusion into the global bond indices. What will this mean for India? A complete explainer and discussion coming up on the show.
And cement stocks are in the spotlight as Ambuja Cement seeks approval for allotment of 47.74 crore warrants through preferential allotment. More details lined up for you in just a bit.
Cipla trades lower as the company gets 3 repeat observations from the US FDA for its Goa plant. More details coming up on the show. All this and much more in the next 60 minutes on Trading Hour. But first, the big story. The big anticipated event to look forward will be India's inclusion in the global bond index. What will this mean for India? Prashant is standing by the big wall with a detailed explainer. Prashant.
Well, thanks very much for that, guys. Now, this is potentially a big one when it comes through. When it comes through is the real question, because we've been waiting for it for a long time. India's inclusion in global bond indexes. Now, speculation and chatter is rife that this is coming, and that is why we are highlighting it here today. Let's get started. Now, just like there are global equity benchmarks like those which are run by MSCI, FTSE, etc., sovereign bonds also have these benchmarks run by, JP Morgan, Barclays, FTSE, etc. And in this piece, we are highlighting how India could be part of these very soon, hopefully. Now, remember, India is the only large emerging market which is not part of any global bond index. Just a bit of backstory to this. When equities were fully opened up to FPIs in 1993, bonds were not. The approach with bond markets has been cautious all these years because of the potential impact on currency. The primary worry has been that hot money will come out, but more importantly, go out when there is a crisis-like situation, and, the currency will get unhinged. So there has been general cautiousness on the bond side, unlike on the equity side. But things started to change from 2013 onwards. Since then, the government has taken various steps like merging the QFI and the FII and other categories into one entity called the FPI, and many other things. All of it kind of culminated in what was created, which is a pool called the fully accessible route. This is nothing but a category into which the government every year puts certain government securities into, and this pool, the fully accessible route, the FAR, this category of bonds is now fully open to foreign ownership. Now, again, go back to the question, why now, you might ask, right? Why should the inclusion happen now? Well, the backdrop to this is the bigger structural theme, which is that India's macro stability, political stability is well recognized by one and all. But something very immediate has also happened. Let me highlight a few other things. Index managers like JP Morgan and FTSE have had India on their watch list for countries which could be included for a while now. The most significant trigger this year in 2022 has been the exclusion of Russia. Russia had about between 8 to 10% weight in these indexes, and Russia got thrown out, not just from the bond index, but from the equity index as well, when they invaded Ukraine. That opened up room, and global investors, bond investors in this case, have been keen to rebalance portfolios, which became unbalanced because Russia was out. So that is being perceived, the eagerness to include in India, which is a very large liquid market, by the way, liquid bond market, by the way, is such that one of the things which was considered a hindrance to India's inclusion, which is non-availability of Indian government securities on a clearing platform like Euroclear, is no longer being seen as a big stumbling block. As to why there is buzz of a speculation now in September, well, that's very simply because JPM's, that is JP Morgan's, which runs one of the largest bond indexes, their annual review happens in September. And as it has so happened last year or the year before that, an announcement also comes around this time. That's why we are talking about here and now this time. Just a bit about the Indian government securities market. This totals, the total outstanding value of government securities, the latest as of Friday, is about 86 lakh crore rupees. FAR bonds, which is bonds in the fully accessible route, owned by FPIs, total around 59 lakh crores. This is a small fraction of the total bonds which are available in the FAR pool. If you total foreign ownership of bonds in the FAR category and the non-FAR category, it works out to 1.41 lakh crore. 1.41, total size 86 lakh crores. Now, this is an illustration which will come up next of some of the big global bond benchmarks and the passive money which tracks these as well, in trillions of dollars and billions of dollars, hundreds of billions of dollars. And India inclusion could result in between 30 and 40 billion dollars in one-time adjustment inflows, because India is not part of it. It'll come into these indexes with some weight. So 30, 40 billion dollars one time. This is according to, analysts at Citi, Morgan Stanley, and others as well. And after that, according to these same analysts, another 15 to 18 billion dollars in annual flows over the next decade could be expected. Remember that compared to other countries, foreign ownership of Indian bonds is very small. I put that number out, 86 lakhs and total size, and 1.41, which is foreign ownership. That translates to 1.6% of the total bond market. And look at other countries. There is plenty of room to grow, basically, is what I'm saying. What are the implications of an inclusion, a potential possible inclusion? Well, there emerges a new source of money into Indian bond markets, which means that yields move lower generally, right? And perhaps slightly structurally lower cost of capital as well. This is also important because, this becomes a big funding source for infrastructure development. It's a new source of money in that sense. Rupee, of course, will have an appreciation bias, which will have to be managed. I'm not going into downsides. It's a whole big subject, and we can't do justice to all of that here in this piece. China was put on the watch list for inclusion in 2017, and the announcement of inclusion came 2 years later in 2019. The actual inclusion happened in February of 2020. Well, India has been on the watch list for 2 years now. So going by past precedent, it's possible. So will we see an inclusion announcement this time for real? Well, time will tell, but if it happens, it sure will be a big milestone for India and its bond markets. Back to you guys.
Prashant, thanks a lot for taking us through all of those details and setting up, for our next discussion. To take this forward, we have Lakshmi Iyer, CIO of Debt and Head of Product at Kotak Mahindra AMC, as well as Jayesh Mehta, MD and Country Treasurer at Bank of America. Lakshmi, as well as Jayesh, thanks a lot for joining us. This is Pavitra. So, you just heard that entire setup that Prashant put forward. We've already seen foreign investors started buying these categories. How much do you see the inflow going up? And like Prashant was pointing out, it's currently around 1.6% of, the total market. Foreign investors are currently only 1.6%. How much do you think this could move up to? Lakshmi, let me come to you first on this, if you could take that one.
So, Pavitra, hi, morning. So clearly the impending announcement is something which market participants have been waiting with bated breath. In fact, traces of this, talk actually started sometime last month, which is why if you see the net FPI or the foreign portfolio flows for the month of August for fixed income, it closed in at a positive about 1,700 crores. Amount-wise, not significant, but clearly a small sentiment booster. So far, up until September, month to date, the number continues to be a net negative, but a very marginal number of about 500, 600 odd crores. So definitely the markets, if at all this announcement happens, which is being spoken about by the end of this month, could be a very strong sentiment booster. The key is to see, obviously, the devil in the details. What percentage of inclusion are we talking about? Are we talking about, completely substituting Russia, which means it could be in the ballpark of about 10%? Are we talking about a shade lower than that? And of course, as you rightly alluded to, what kind of timeline we see in the actual culmination. So euphoria might be there, some bit of it has built up, but sustenance of that euphoria, to my mind, is a bit of a question mark right now till we get more clarity on the details.
Okay, morning, Lakshmi and Jayesh for joining in. This is Rima here. It almost seems now it's a matter of when and not if anymore. With Russia going out, there is space, and all investors want a piece of India's growth story. And India's, its growth story has been pretty intact and resilient over the last one decade. Jayesh, coming to you. Lakshmi said the devil lies in the detail. And more importantly, it all boils down to the kind of percentage that India will get. What is your own estimate? And then also on the timeline.
So on timeline, of course, if the announcement comes by, say, September end or maybe mid-October, whenever it comes, right? The actual inclusion timeline could be maybe 6 months to a year away, but the market definitely will price in if it is announced by October, mid-October or so. So that's one good thing people are waiting for. Of course, market not reacting too heavily right now because, last 3, 4, 5 years, we have been always waiting for it, but this time it looks a little bit more real. Mainly because of investor demanding it. So if you really look at it, what the index guys wanted, nothing has changed from that particular side of it, except for the accessible route, which has been made unlimited. So that's good. And as far as settlement is concerned, we have great settlement systems in India, so that will have to get accepted by the index guys. So that's going to be a cliffhanger, whatever the decision comes in. But definitely there is huge investor push to get India into inclusion for a simple reason. Like if you like that market, you want to invest, as long as you make money, you're fine. But the moment you lose money and it's not part of index, people are going to question you. So that's where the challenge is. Now, in terms of estimation, we don't really know if it gets included or not. Secondly, the ballpark number, most of the analysts have come back is around 8 to 10%. So that's the number we are looking at. Even 8% is a good big number to start with. So irrespective of whatever the timeline is, 6 months, 1 year, the market will react as soon as the announcement comes in. So that's where people are, keeping the wait and watch situation. Also, apart from JP Morgan, we will also have Bloomberg Barclays meetings somewhere in mid to end October. So both the things, the whole of September, October will be wait and watch kind of situation.
All right, we're waiting by for all of those details, of course. But Jayesh, a key risk that we have been discussing is the fact that this, inclusion into the global markets could sort of make India's debt market more vulnerable, right? Any kind of big global event that we have been seeing so many of, whether it's a Fed rate hike, could sort of expose our markets to more vulnerability. And as foreign investors might want to withdraw money at that time, how much of a risk do you think this is to the debt markets overall?
So firstly, we are, as of right now, as Prashant's chart said, right, we are almost funding 98% locally, domestically. So to that extent, we have a very strong and vibrant domestic market, number one. Number two, when you're part of index, right, so people, when they have negative view, it's just a question of, overweight, underweight, but you don't really move out, assuming, I'm just saying, hypothetically, assuming it's 8% or weightage, So when people have negative view, maybe they may go down to 5-6%, not more than that, unless you had a situation what we saw in equities from October 21 till July 21, which was one-way kind of situation. Naturally, when that kind of situation comes in, you have the central bank who will have a lot of ammunition, because if once the FPI index inclusion happens, the need for central bank to buy government securities will reduce dramatically, looking at the demand supply which we have in India.
Lakshmi, Jayesh mentioned that one of the cliffhangers could be the global indices accepting India's settlement as well as clearance. Are there any issues, other issues, challenges which stand in the way?
So, these were the two key things. One is the settlement, which is the euro clearability, which seemingly, because there is a massive investor push right now, from what we read and understand, that seems to have taken the back burner. And the second was the taxability issue. I think both of these, for now, does not seem to be a roadblock, given the fact that, there are 2 or 3 sets of foreign investors who usually own a particular geography. We are right now probably looking at more of the index others, as we call them, the passive investors, who, the moment they see inclusion of a particular geography or a particular category into the index, tend to just own the index in that particular proportion. So that could well be a starting stone or stepping stone towards probably much more broad-basing requirements as and when needed. But seems to me that, the story that we all saw or read in school days, the boy who cried wolf, and this boy has been crying wolf for, as Jayesh rightly pointed out, for the past 3 to 4 years. The timing seems to be right now.
Just one more question. We spoke about the risks, the vulnerability that it exposes India. But can you talk about, once it gets included, once the announcement comes through, what will be the beneficial impact, whether it's on India's external balance, the current account deficit, the impact on yields? Because now, as Jayesh pointed out, the RBI will need to buy less of government securities. How much do you think the immediate impact could be once the announcement comes through?
So, the moment the announcement comes in, it's not that the passive investors or the other FPIs are going to, make a beeline and start making the investment. So initially, that round of fueling of the rally in bond prices or, lowering of the bond yields could be triggered by the domestic investors, as we rightly observed as a maybe euphoric reaction, because markets are kind of piling on hopes and then giving up hope. So that's the kind of cycle which is going on right now. Subsequently, as the announcement gives way to the tangibility of the timelines of inclusion, the estimate, ballpark, depending on its 8-10%, would be anywhere in the region of $25 to $30 billion, which means, given the second half borrowing calendar, if we broadly see, we are talking about 30,000 odd crores of weekly supply, which means the next 2 to 3 months or 2.5 months of supply could actually get absorbed, which means the Reserve Bank of India, if at all they were to probably come in the market to buy bonds, that need would stand reduced to that extent. So that's the kind of quantum and magnitude and the potential impact this announcement can actually have, maybe with a lag of the next 2 quarters.
All right, got that. Jayesh, just one final question to you. This is something Prashant was also mentioning earlier, the impact that it could have on the rupee. What do you see as, the key impact? Yes, we could see some appreciation pressure, but you tell us what is perhaps likely to be an immediate impact of this kind of a move.
So once the announcement comes, even if the real money guys who follow index may take 6 months to 8 months to come in, there will be a lot of trading FPI accounts who would be also participating it. So from that perspective, you will start seeing the flow immediately. And you see, FPI flows impact the short-term, rates dramatically, because that's the chunky money which comes in or goes out. Either way, whether it's equity or whether it's fixed income. But if you see sustainable flow coming in, and if the announcement comes, you might see sustainable flow coming in for a longer period, and that definitely will put appreciation pressure on rupee. But we have to see how much RBI lets it appreciate. So that's the question we'll have to see. But yeah, definitely looks like, it can go to 78 quarter. And then that's the time we would see RBI rebuilding the reserves again. But that completely depends on RBI.
Jayesh, Lakshmi, thank you very much for joining us and setting us up for if and when the announcement comes through. We've been waiting it for the last couple of years. Let's see if it comes in September as well as October. Get into a break on that note. Up next, we'll discuss what's happening in the commodity space. Manisha Gupta joins in next.
Welcome back. You're still tuned into Trading Hour. It's looking good for the markets. We're currently around 125 points in the green, so there's been quite a recovery from the levels that we had earlier, where we booked at one point down around 50 points. So we've seen a good recovery from those levels. But let's move on and discuss what's going on in the world of commodities as well now. Manisha joins us, and today she's focusing on natural gas. Hi, Manisha.
Hi, Pavitra. And we have seen the prices decline overnight. In the last week as well, we were trading in the negative, and that's exactly how we've started this week as well. So nearly 4% of a cut coming in for your screens. And in the international U.S. gas prices, we have seen it decline below $7.8 per MMBTU. It was not too far back ago when we saw the prices trading at a 14-year highs of $10 per MMBTU as well. So it has been a sharp decline from there on. In the Indian markets as well, we've come down from nearly 720 of a high to almost 606 in a matter of 1 week itself. Well, the U.S. Railroad and the labor union agreement to avoid the rail shutdown is something that tells you that the supplies will continue to be smooth, and that's taken the premium off the prices. Apart from that, the inventories in U.S. have gained more than what the street was expecting at 77 billion cubic feet. Street was estimating 73 billion. So we have seen an uptick come in for there as well. And then when you look at the supplies, those have been increasing in the U.S. markets there. There are a couple of ports which are on a maintenance shutdown. For example, one of them clearly is Maryland Cove. So that is the LNG plant which is down for maintenance. So there are more supplies available for the U.S. markets there. And then remember that Freeport LNG gas, where we did see a fire, that has seen a very delayed startup as well. That seems to be putting prices under pressure. It's not just the U.S. gas prices. The European Union, the UK gas prices have continued to decline as the regulators there continue to outline details to intervene to curb the prices there. You are also looking at the Goldman Sachs report, which came in over the weekend, which says that the natural gas prices will continue to decline. And by the first quarter of 2023, you could be looking at the prices nearly half from where we are trading right now. That is what the prices have done on a week-on-week and a month-on-month basis. As you can see, it is all in the negative, with the UK prices falling the most. But as you can see, 8 to 20% down on a week and nearly 20 to 25% down on a month is how that is.
Manisha, thank you very much for that. Get into a break. Up next, we'll discuss market technicals. Gaurav Ratnaparki of Sharekhan joins in next. Welcome back. Let's talk about the market technicals. Gaurav Ratnaparki of Sharekhan now joins in for a quick technical check on the market. Gaurav, we've rebounded pretty well after the cuts that we had towards the end of last week. Would you buy into the up move? What are the key levels that you're tracking and your stocks?
Yeah, good morning. I would rather prefer it as a selling opportunity. Basically, if you look at the index structure, in the last week, Nifty made multiple attempts to cross 18,000 mark, but it could not sustain in the higher territory. The level of 18,100 indeed acted as a strong resistance, where the Nifty stumbled near its Delhi upper Bollinger Band for 3 consecutive sessions. And even the early upper Bollinger Band put additional pressure on the higher side. So from there, Nifty has entered short-term correction mode. Last week, what we saw was first leg of the correction. And today we are seeing a minor degree bounce back, which is expected to be followed by the next leg of the correction. So basically, this bounce is actually an opportunity to initiate fresh short position. For short-term traders, around 17,680, 17,700 will be the zone where they can consider initiating fresh short position. Keep a stop loss of 17,800, and on the downside, 17,500 and even 17,200 will be the targets to watch out for. And in terms of stock-specific action, I have picked up one long and one short idea. On the long side, I have picked up Eicher Motors. Basically, this counter has been one of the outperforming candidates within the auto pack for last 1 month. And the structure is showing strength for short term as well as medium term. And on the occasions of minor degree dips, this stock has been taking support near its 20-day moving average. So keeping a stop loss below 20-day moving average, one can initiate fresh long position. So stop loss will be 34.50, and on the higher side, targets will be 36.80 and 3800. Whereas on the short side, I have a counter from Metal Pack. Basically, metal space has seen a distribution in last few weeks and is now prepared for the next leg on the downside. In fact, the next leg of the correction is expected to be driven by Metal Pack. So this counter, National Aluminium, has formed a bearish outside bar as well as an engulfing bear candle on the weekly chart. And the follow-through selling is expected in this week. So I have a sell on National Aluminium at current level with stop loss at 79.50 and targets will be 73 and 70.
All right, Gaurav, got that. Thanks a lot for joining us and taking us through that quick technical check on the market. With that, we're going to get into a short break now. But when we come back, we'll discuss the way forward for the market. Rohit Srivastava, founder and strategist of IndiaCharts.com, will join us.
Welcome back. Let's tell you what the global spotlight is. Well, the top story this week is going to be about the Fed rate hike, how much it raises. But apart from the Fed, did you know that there are 14 central banks around the world who are meeting this week to deliberate a rate hike? We're talking about, on the whole, 15 central bankers meeting this week. Prominent ones include, of course, the United States of America, where the Federal Reserve will be meeting. But apart from that, Bank of England will be meeting, Bank of Japan will be meeting, and these two economies also count among the top 5 economies in the world. We've also got banks in Switzerland, Norway, Sweden, South Africa, Philippines, Indonesia, Brazil, Taiwan, Egypt, amongst a few others. For the Federal Reserve, the focus will not just be on the magnitude of the rate hike, whether it's a 75 or 100 basis points rate hike. The recent CME Fed tool forecast is now forecasting an 18% chance of a 100 basis points rate hike. This is after the red-hot inflation print that we got last week. But the attention will also be on the dot plot projection, which will indicate where the terminal rates are going to be and for how long the Fed will keep hiking rates. Let's move on and now quickly tell you what we can expect from the other central bankers this week. Well, Bank of Japan is expected to stay pat, like it has been for the last many months, resisting the global tide of increased interest rates. Bank of England could be raising rates anywhere between 50 to 75 basis points when it meets on Thursday. The reason why the street is still divided on how much Bank of England is going to raise, because there is some key data which is going to come out ahead of the Thursday's meeting. The July GDP is out. The August inflation figure is also expected in the run-up to the BOE central bank meeting, which could sway the MPC. Switzerland's central bank is also likely to raise interest rates by 75 to 100 basis points, ending a 7-year experiment with negative interest rates. As of today, Switzerland is the only economy in the world where interest rates are still negative. But after the rate hike it takes in this week, which it is expected, that could end after a period of 7 years. But the one which I found most interesting is Turkey. Well, Turkey was, it's an economy which had seen a 100 basis points rate cut in August. What will it do in September now? It's been focusing a lot on growth over inflation as tourism has dissipated. But did you know its inflation is running at 80%? And despite that, we had a rate cut by Turkey last month. And the question is, what will it do this time? And finally, Norway and Sweden, well, they could follow, the path ECB took, right, with a 75 basis points rate hike. They're a part of the Eurozone, so they could have a rate hike similar to what ECB took. Well, the moot point is, around the world, Economies are quickly accelerating the monetary policy normalizations, and investors are pricing in a very sharp surge in interest rates over the coming months. So it's not just Fed, which is going to be on everyone's watch. Keep your eye on what's happening around the world in terms of central bank action. But that's about the global markets. Let's quickly talk about the Indian markets. Rohit Srivastava, the founder and strategist at IndiaCharts.com, is joining in on the show now. Rohit, morning, and thanks so much for joining in. First, your thoughts on the markets, the setup, where we're headed?
My sense is after what we have seen last week, the Nifty itself has peaked very close to the high that we made in April near 18,115. And the Bank Nifty got close to the high that we'd made in October of 2021 near 41,830. I think these two become a very important testing levels because both of them would amount to some type of a double top happening in the market. Bank Nifty at a bigger degree and the Nifty, which has sort of made lower highs all the way from October to January to April, and now we have multiple highs which are lower, and that sort of keeps the larger trend in check, which is that despite we've had these strong rallies from time to time, the overall trend of the market has remained low, except that we've seen different sectors participate at each point of time. But my sense is we are getting to the part of this crisis, which has been linked to inflation and rising yields, where we might be in the final stages, where you actually get more of a broad-based, decline, corrective decline across sectors. And that is, I think, the risk in the weeks ahead, which is where we are sort of stepping back and taking a seriously cautious approach at this level in the market.
Okay, you're saying that you could see some sort of consolidation ahead, and probably, we also do have a big event this week, which is of the Fed meet. Rohit, good morning, and thanks a lot for joining us. Do you think in this setup there are pockets which seem, perhaps better positioned to do well at this time?
So the only pockets, and I would say when we say position to do well, if we are anticipating a possible, a downward trend in the market, is that what will relatively hold out. So the two sectors, I think, which can relatively hold out, maybe either by falling less, or if there are some gains, would probably be pharma and defense. Defense has, of course, been strong anyway, so it's easier to spot that as an outperforming sector. But pharma has actually been an underperformer because the pharma sector has been weakening even ahead of when the index peaked out. So it's been one of the poor performers post the very strong performance it gave in the year of the pandemic. After that, the pharma sector simply didn't do much. And I think that could end up providing some kind of surprise, if at all, because when markets do correct, sometimes money gets reallocated to defensive sectors, and pharma would be one of them that would really attract that kind of, allocation. So I think that could be a surprise. So these would be the two sectors I would think of, in a potentially weak market.
How long do you think the markets could remain subdued or weak? You've put a target price of 16,700 over the medium term. How long will that medium term last? Because we have been in a time-wise correction for nearly a year now.
So one is the long term. So when we think of long term, typically bear markets in India have lasted anywhere between 15 and 21 months. So if you take it from the peak in October of 2021, 15 months would somewhere put us, close to Feb of 2023. So that would be sort of a timeline for a bigger picture to play out in terms of whatever downside risk might exist. Now, when I'm talking of 16,700, it's slightly more medium term. So we are not looking at the big picture, but looking at more the immediate scenario. After the selling that we saw on Friday, the first level of support is going to be at around 17,300. Now, if we do break that, we head to where the weekly averages are, and that's sort of in the 16,700, 16,800 range. So that's going to be the first testing support that we are going to look at. So those are more like levels we are looking at in a time horizon of maybe 3 to 4 weeks.
Rohit, we have been talking about this entire divergence from what's going on globally, but generally, if you take a look at it, it's normally not something that can sustain for a very long period of time, right? Do you think it's only a matter of time before we sort of do start reflecting the kind of hit that we are seeing in global markets as well?
I definitely think so. I'm not in the decoupling camp, having seen markets for long enough of a period I think we've seen such deviations last for several weeks or several months even. And we can go back to 2008, between October of 2007 and January of 2008, the Indian markets continued to make higher highs even as the US had actually rolled over. That's not the only example. I can even go back to 2001, midway through that bear market after Y2K. The Indian markets diverged between October and February of 2000, 2001. And we continued to make higher highs even as the Nasdaq was making lower lows. So this does tend to happen. And many times the thought is that, well, Indian markets are in a better place and therefore, certain stocks start performing as value buying steps in. So I think we've seen a bit of that over the last, month or so. But eventually, I think the risk of, tightening liquidity conditions, which is the right word, I think, of what is really happening. So even if you keep all things equal, fundamentally the macros of India, everything remains equal, tightening liquidity conditions are the single most factor that sort of affect valuations. So valuations themselves get triggered to move to a lower level. And that is, I think, the risk that even India would face despite all the positives that are there. And so as long as we are moving into a tightening situation with multiple, as you mentioned, multiple central banks coming in over the week, and they're all the policies are moving in the same direction, markets are likely to contract and can't keep breaking away from what is looking like a global trend.
And the biggest impact has been on the IT sector. What does the risk reward now tell you for the technology sector after the kind of underperformance we've seen?
So the IT sector, in fact, is the closest mirror of what is happening in US equities and specifically the US tech sector. So it's moved very much in line, unlike the Nifty, which appears to outperform. Last week, the IT index has in fact broken the previous low, exactly like the Nasdaq has also done during the last week. So if we expect further weakness, which we do in US markets, I think the IT sector would see most of the damage, and which is why, even though it's fallen so much and it may appear cheap to some, I think the maximum risk is still in the IT sector because it is so externally driven, and so we'd still continue to avoid it till we can see the black clouds really go away from what is happening in global equities.
All right, still avoid the IT sector, but what you're sounding slightly better on is the pharma space as well as some of the defense stocks. With that today, thank you very much for joining us and taking us through your outlook on the market. With that, we're going to get into another short break, but up next, Ambuja Cements is in focus. All of the details lined up for you when we come back. Welcome back. You're still tuned into Trading Hour, and let's talk about the cement space now, which is really buzzing around. Adani Group is now the second largest company in India with the acquisition of Ambuja as well as ACC. Speaking after the completion of the acquisition, Adani Group Chairman Gautam Adani said that the conglomerate hopes to become the most profitable cement maker in the country and sees demand rising significantly going ahead. So let's listen in to some excerpts from that speech.
India will be a $25 to $30 trillion economy by 2050. While India is the second largest producer of cement in the world, our per capita consumption is just 250 kilo compared to 1600 kilos of China. This is almost 7x headroom for growth. Furthermore, as several of the government's programs gather momentum, the long-term average growth in cement demand is expected to be 1.2 to 1.5 times the GDP. We anticipate growing at twice these numbers. We expect significant margin expansion to become the most profitable cement manufacturer in the country. And we anticipate going from the current 70 million tons capacity to 140 million tons in the next 5 years.
Okay, those are the stocks in focus. Nigel is also here with us to detail what brokerages are saying. Nigel, going by the stock reaction, the street is very enthused. Ambuja Cement is up close to about 8% and ACC2 is higher.
Well, that's right. The street has taken it very, very positively that the new promoter, that's the Adani Group, they're infusing close to around 20,000 crores via the way of warrants into the company. Over the next 18 months or so, they have that option of converting it. And on conversion, well, the promoter holding will increase from around 63% all the way to around 70%. The big statement, though, that came out from Mr. Gautam Adani is that by 2030, they're looking at being the most efficient and the largest cement company here in India. As of now, the largest cement company is Ultratech Cement, and they have already drawn out a roadmap where their capacity will be nearly around 155 million tons by 2025 odd. So effectively, Gautam Adani is saying that the capacity of ACC and Ambuja put together will more than double in the next few years or so. And rough CAGR out there would be they're looking at increasing capacity at the rate of close to 11 to around 12%. The rub-off effect where Ultratech Cement is a relative underperformer today, while there is hope of consolidation, and that's why you have a couple of names like India Cements and Nuvoco, they are running away. What are brokerages making of it? Goldman Sachs, they say that they have a neutral rating on the stock with a target price of around 380 rupees. They're saying, assuming that this 20,000 crores odd is used for inorganic growth, well, it suggests a potential incremental value of nearly around 23% to around 47%, from a year on in comparison to the current target price of around 380 rupees. And they've given a few scenarios that are up for you on the screen. Investec, they say that Ambuja, well, that's the preferred play rather than ACC, despite the valuations. And they, in fact, have downgraded ACC to hold. The key reason they're saying is that Ambuja will be used as a key vehicle for Adani's cement foray. And they're also citing a couple of other factors like synergy or optionality as well as higher growth for Ambuja in comparison to ACC. They're also saying there's a probability that ACC and Ambuja get merged at a later date. Finally, Jefferies, they have a buy rating on ACC, but they've gone ahead and they've upped their target price big time on Ambuja Cement to 620 rupees. They've raised the consolidated EBITDA. They're expecting by around 20 to around 30% for the next few years, assuming higher volumes, assuming higher EBITDA per ton, and also factoring in synergy benefits from December 2022, which will gain momentum from there on. So put all this together, Ambuja Cements, the big gainer, Ultratech, a relative underperformer, and a couple of stocks, they're gaining on hopes of some consolidation in the space. Back to you guys.
All right, Nigel, thanks a lot for getting us all of those details. So that's a complete roundup on what's going on in the cement space, and some of those stocks are up on your screen. All of those seeing some big gains. Ambuja is up over 8%. We're going to get into a short break now. The market has come off a little bit, so it's just around 70 points higher now. We've lost around 50 points from the start when we looked at it at around 11 a.m. So we've seen a little bit of a let up there, and the mid-cap index is in the red, around 0.3% lower. So quickly, let's get into a short break now. But when we come back, we're tracking lots more market action.
Welcome back. One of the stocks you should keep on your radar is McLeod Russell. It was up 20% on Friday, and it's once again locked in an upper circuit of close to about 20%. On Friday, we had a block deal of nearly 5%. There is a Kolkata-based group which acquired their 5% stake. And today as well, early in the morning, there was a block deal of nearly about 1.9%. And since then, the stock has been locked in an upper circuit of close to about 20-odd%. Another one is Campus Activewear. There is a note which has come out from Motilal Oswal which says that organized and branded players can grow at 1.5 times the overall rate of the market growth. So they're quite bullish on Metro, Campus, as well as the others like Relaxo. So we'll keep getting you more stories on that, but that's a stock which has gained close to about 5%. Another one on our radar is Adani Wilmar, which is all set to expand its ready-to-cook range. Shilpa is here with the details.
Well, Adani Wilmar had mentioned even when it was filing for its IPO that it is going to focus a lot on the ready-to-cook segment, and now it is set to expand that segment. What we're given to understand that the company is going to launch a whole range of rice-based ready-to-cook products. Now, it's going to leverage its recent acquisition of the Kohinoor brand that happened in May for this. So we're given to understand that it will be launching products like a do-it-yourself biryani kit this fiscal, and that will be under the Kohinoor brand. It is also looking at a range of other ready-to-cook products like for example, Mexican rice, Thai rice, fried rice, and other rice-based products. But this could either be under the Kohinoor or Adani Wilmar's Fortune brand as well. That is yet to be decided, and a couple of these products will be launched this fiscal as well itself, and the remaining would come the next fiscal. Now, if you remember, currently Adani Wilmar sells has an RTC portfolio of just khichdi products where it sells about 6 variants of that products. It is also looking at expanding its breakfast range, where it currently only sells about 2 variants of poha. It is looking at more variants of poha that would be localized to each locality, and also similar breakfast items through which it wants to expand that entire range under breakfast. Now, the focus, however, for Adani will remain on ready-to-cook and not ready-to-eat products, since it says that the traction is coming on that end. Back to you.
All right, Shilpa, thanks a lot for getting us all of the details on this, on Adani Wilmar. With that, we're completely out of time on the show. It's a 70-point gain on the Nifty, and a big bunch of this coming through from the banks, specifically the PSU banks, which is up 2.5%. So thanks a lot for tuning into Trading. Our halftime report is up next.